Howdy, Jacob here. Today we're looking at Nokia, one of the most popular companies back in 2000. Don't know why I said 20 like it was something else. In the peak of 2000, the dot-com bubble, which is more famously known as, company's stock price was as high as $55, and even in the Great Recession, we're looking at a peak of 39. So it is still 90% drop, over 90% drop, maybe even 93% drop in the last 24 years. But that's because it was so inflated. We're looking at the actual business and we're looking at cash flow. And I presume back here it was just based on growth. And so we're looking at the business more recently, and we can see that it definitely looks a bit more attractive with a 4.4% P or a 4.5 PE, 3.7% dividend yield. It's a $19.1 billion market cap with $15.7 billion in enterprise value. Interesting for a communications equipment company to have a lower enterprise value than market cap. So that is interesting. Let's look at that balance sheet. So 4.5 billion in long-term debt. They have 5.8 billion in cash and cash equivalent, 3.9 in short-term investments. So they have almost $10 billion in essentially cash equivalents, very liquid assets, and they have 4.5 billion in long-term debt. So from a balance sheet, this is a very healthy balance sheet, one that is going to make assumptions just based on cash flow. You don't have to increase discount rate or think about what the balance sheet's doing in the background. They're paying out $615 million in dividends to get that almost 3.8% dividend yield. And in a 5-year average, looks like 2018, 2019 were poor performing years where they had negative free cash flow. But then in the last 3 years, they've performed in 2020 about $1.6 billion, $2.4 billion, and $900 million. And so from the last 3 years, they can definitely afford it. But the rolling 12, it looks like they're producing negative free cash flow. So it's definitely appears to be a very volatile free cash flow business, which is not most attractive. I don't mind when the net income is very volatile because there's so many ways of accounting that you can like write things off, or other non-operating income. You can just write things off to where it looks like you performed very negative on the net income side, because there's tax involved. But on the cash flow side, it gets built back in because there was actually no negative outflow of cash. So it is weird to see such volatile free cash flow for communications and equipment business. But 2013, $16.1 billion revenue up to $26.4 billion. It looks like a lot of growth, but from 2017 to 2022, it's actually declined. So we're seeing negative growth there. Interesting that in like where I'm saying right now is maybe the peak of their performance. 16% ROIC looks great, but then again, because it's so volatile, you have negative return on invested capital for the 3 years prior to COVID, really. So I think we can start making some assumptions here. I'm really going to be going off of averages since it's such a volatile business. I'll say that the revenue growth is probably pretty close to zero. Maybe they invest in some things that work. Maybe some of the things they already invested in decline. They're going to average out to roughly flat growth. And then 10 on the P and price free cash flow. I don't think there's any reason a company that doesn't really have a moat, I would say, by any means, deserves any sort of inflated value to their terminal P and terminal price to free cash flow. As for margins, their gross margin went from relatively flat. I mean, it's also pretty volatile, as high as 45%, as low as 35%. And then operating margin looks to be about 10% when they're doing well, and then pretty much flat, maybe negative when they're at the trough of their cyclicality. So if we just average it out, that's probably just what I'll do. I'll do 3.5, 4.5, share change, no share changes. As for the dividend, I think a 600 million payout is probably fine just based on their balance sheet. They have so many liquid assets in comparison to long-term debt, so it's not like it's a debt-ridden company that can't pay for it if they're in a cyclical year. So I think when they do perform well, I think the payout is less than half, and then when they don't, they'll have to dig into their cash and cash equivalents, which I think is fine for a company as big as Nokia that maybe doesn't have a lot of growth potential. I don't know. Maybe they're getting into some crazy things now, but over the past 20 years, haven't seen them grow or invest too much into uh, maybe new tech. But not to say that not to say they won't, not to say they can't, not to say they're not in the in the ring right now trying to figure it out. But for me right now, I think I'm comfortable with that payout. I'm not going to increase it or decrease it. And that still gets us to a value that the company stock price would need to fall 65% before I'm looking to do more research on it. So definitely one of the hottest companies during the dot-com bubble. But for me right now, it's just I just don't see all the growth there. I don't see how the dividend is that attractive. I mean, it almost meets the mark of our 4% screener. It's 3.77%, but and I do think they can afford it. I think their balance sheet's very attractive. I definitely put it on your list of companies to possibly invest in for a dividend investing. But for me, the price appreciation that I think would come with it is definitely not worth it at this price point. So for me, I'm just waiting. Thank you and have a good rest of your day.